Alright, welcome to our weekly update on the Australian property market, where we discuss waves, impulsive waves and corrective waves around Australia. It looks like property bubbles are popping all around us. Some have already popped a while ago and now are limping along, waiting for another hurdle that will flatten the curve. I have a whole bunch of charts prepared for you to crunch, so if you like this content, give it a thumbs up and subscribe to the channel. Today we're going to focus on various European housing markets. So far, we have discussed what's happening in China, Hong Kong, New Zealand and Canada, which are going through last stages of this multi-decade bubble. There are literally one or two big spikes away from peaking, as interest rates are going to go backward again within days, based on the movement of the US 10-year bond yields. This will trigger the stock market and gold and Bitcoin to melt up. What's worrying is the fact that all these markets that I mentioned are in the falling formation, which means the rise is going to be short-lived and we will not have higher highs. On the other hand, most housing markets are still running their upward course and haven't peaked as yet. It may change after the incoming event that will crush stock market by the end of this year. So after significant gains over the next few months that will overshoot previous highs, the housing market around the world will grind to a halt. I have no idea what will trigger it, but it will shock credit markets that are fueling this rapacious cancer. Lowering of interest rates is going to run for a while, as the US bond yields may go as low as 2.1% or even 1.818%. It's a slow process and may take more than 6 months. That is how long it may take for housing markets around the world to peak and finish off this huge cycle. What happens after that, you may ask? A slow and painful descent from the peak that will take decades, just like it has happened in Japan and Korea. But before we get there, let's see what's happening in Europe. As we learned in part 1 of this series, Italy and Spain have already blew up and ended the cycle. They are already zombified like Japan. Both these markets peaked in 2008 and never recovered. The recovery won't happen anytime soon. This may fly in the face of those who claim that high immigration is going to blow the bubble to infinity, but we'll discuss it in another episode. While Southern Europe is already toast, the rest of the continent is running on fumes. The housing index provided by BIS and Fred indicates red flags all around Europe. It looks like the fiscally prudent countries with stronger currencies managed to delay the bubble expansion from getting out of control and blowing up prematurely. While Spain and Italy already started the final fifth wave in 1985, Switzerland has delayed it until 2002 and Germany until 2010, after a whopping decline that lasted for 30 years. I believe Germany has a controlled housing market with regulated rents and taxation, which does not promote home ownership nor house speculation. Therefore, it's out of whack, artificially delayed in a cycle. For the German economy that has entered a recession this year, these elevated house prices seem to cause even more trouble as they drain liquidity from future earnings. Germans managed to make up the lost decade and pump up a humongous bubble since 2008, something that took Italy 2 decades, Germany managed to achieve in only 11 years. It is reminiscent of another highly controlled market, and that is China. On the broader scale, like in Italy, the cycle started after World War II. Here's a wave 3, wave 4, and the final 5th wave. The housing index indicates we've reached the peak. However, when you look at particular cities and use absolute numbers, you'll find that the bubble keeps growing. Here is Berlin. The final 5th wave started in 2011. It is made of smaller wave 1, wave 2, wave 3, wave 4, and the final 5th wave. There's no more growth past this point. As you can see, we are very close to the very end of it. Could it take 6 months to finish it off, counting from today? If the second wave took 28 weeks to conclude, I'd say each remaining wave may last as long, which brings us to a 12 to 18 months mark before it goes belly up. Is it the right time to buy property in Germany though? Next on the radar is Switzerland. Just like in Germany, they have kept their housing market under relative control, but the injection of currency into the system eventually hit them too. Here's wave 3, wave 4 and the final wave 5. Geneva's market looks frothy. It has started the final 5th wave in 2014, and it looks like they're just concluded wave 3 and 4 within that final wave. What's left is the final spike up, corresponding to the final 5th wave, which will close this cycle. Timing might be tricky to evaluate, as the first wave lasted for 3 years, but it shouldn't go past that point. Next on the radar, we have Norway with its oil fund and high immigration, while the National Housing Index indicates we have reached the peak. Here is wave 3 that ended in 1987, followed by wave 4 that lasted 80 years. Currently we're in a final wave 5 that consists of 5 smaller waves. Wave 1, 2, 3, 4 and anticipated 5. However, when you look at the individual cities, you realize there's more fuel left before we see the final bang. Wave 1, 2, 3, 4. Now we just started the final 5th wave, which is about to have a decent spike up, corresponding with halting or lowering of interest rates over the next few weeks. It will be followed by a short correction and another final spike up that will conclude the cycle. Again, all these markets seem to be addicted to low interest rates, hence they rise in unison. Nevertheless, we can see the light at the end of the tunnel. The same applies to the Netherlands, with wave 3, wave 4 and the final wave 5. Sweden, here's wave 1, 2, 3, 4 and 5. And the UK. Just like in any other Western economy, the UK is going through a major population reshuffling with a huge influx of newcomers. It's worth noting that those who've had money to spend on property are already here. The new arrivals don't have the money to splurge on a 6-figure priced house. They can only rely on the fractional reserve banking. Interest rates are about to get slashed, or at least put on hold, as the US bond yields just hit the brakes. That means more sugar for the drug addict called the real estate market. We might leave the UK and Ireland for the next time. Until then, stay calm and count waves.